Hello, and a very warm welcome to the FCSA's webinars IR35 off-payroll reforms for the recruitment supply chain. There are now only a few months to go before the reforms come into effect, and that means that it's time to firmly put this issue back on your agenda. Some time ago, in April 2020, a number of you were fully prepared to take on these new reforms, and a number of you were not. And with that in mind, we've created a comprehensive series of webinars, 3 in total, to allow you to walk through all of the things that you need to take into account in order to be ready, prepared, and to embrace the reforms when they come into effect on April the 6th next year. With that in mind, I'd like to hand over to Chris James, who will take you through more of the detail.
Thanks very much for that introduction, Phil. Hi, I'm Chris James, and let me take you through what we're going to cover today. We're going to look at the standard constituents of a recruitment supply chain. We'll then consider briefly how employees are normally taxed, how limited company contractors are normally taxed, and then we'll move on to exactly what IR35 really is and off-payroll and how it works. We'll then go through some myths around IR35 and some of the key indicators that make a contractor look like an employee. Then we'll go back to the supply chain and look at how the new off-payroll rules, the new version of IR35, affects the supply chain. We'll then consider the picture in 2017 when these rules appeared in the public sector, and what we expect to see therefore from April 2021 when the rules belatedly arrive in the private sector. So then in detail, what's the impact on the recruitment supply chain of these changes, and what should you do next as an end hirer or an agency if you haven't started preparing already? I'm Chris James, and the reason I'm talking about this today is because historically I was a chartered accountant with a special interest in contractor taxation. I'm now the Director of Accounting Services at JSA Group. They're an FCSA accredited member. So with a background in chartered accountancy and audit, I've ended up working significantly on IR35 employment status. And through my work with the board of the FCSA and being the chairman since 2018, I regularly meet with HMRC and the business ministry bays and people at the Treasury who write these rules. And so I've got a good understanding of what they're trying to do with these rules. Although, as we've seen in particular recently, it's not always the case that the intention of HMRC is fully represented in the law that's passed. So, what are we talking about today? A standard recruitment supply chain, which I'll describe several times during the conversation today, will have an end user or an end client, and that's the term we're going to use for the business or the organisation that needs the work doing that we're looking at in this supply chain. So that could be in the public sector, something like the NHS. In the private sector, it could be a bank or something like that. We'll then normally in the supply chain have an agency or some other kind of recruitment intermediary. They may just be finding people, they may just be, but they may be supplying whole work. But either way, this is what the supply chain will look like. And we then traditionally, when we're thinking about IR35, we've got what's called a PSC. That's a personal service company. Here I've called this one Dave Limited, and I'll keep using that terminology during the talk. And then we've got a worker, Dave. And so in this supply chain, the work is probably going to be done by Dave through his company, Dave Limited. And that's going to be supplied through a recruitment intermediary, traditionally just known as an agency, to an end client or an end user. And in return for that work, payment will be made down the chain. Obviously, the agency will take a cut for its supply of the services. A payment will be made to the PSC, and then the PSC can pay Dave in a variety of ways, as we'll go over in a minute. So in that case, what we've described on that picture is a traditional situation where a PSC is going to pay Dave probably in a reasonably tax-efficient way. But of course, it's perfectly possible that instead of the PSC being in place, the agency might want to pay Dave as an employee of the agency. And also they might want to use an umbrella company. So the agency might put an umbrella company in between themselves and Dave instead of the PSC. So that's the way the supply chain will work. Yeah, we're going to start with the PSC situation, but as noted here, It could be that Dave is an employee of the agency or an employee of an umbrella company that the agency pays. So if we are an employee, how are we going to get taxed? Well, all UK resident employees have a personal allowance, which is an amount of income that they can receive with no tax due. And above that, they'll pay tax through PAYE, depending on the band their income is in. Starts at 20%, then we move up to 40% later, and so on. An employee will also pay employees' national insurance, again above a minimum threshold. And the employer, whoever pays them as an employee, will also pay national insurance, their own version called employers' national insurance, again with a minimum threshold. Pension payments and the apprenticeship levy, and of course allowances for holiday pay, etc., may well also need adding on top when you're considering the total cost of the employee to the employer. So if someone's going to pay an employee, they have to bear in mind all those costs on top of their gross salary. Now, by contrast, a limited company contractor, the limited company itself, so Dave Limited, would receive an income from the agency and the supply chain we described, rather than Dave receiving a wage directly. So the limited company receives sales income. The contractor then, normally, if they've got a choice about how they structure their affairs, will choose to take a small salary from the company, and this will use up that personal allowance, kind of free pay, so that little or no personal tax will be due on that payment. Some expenses can also be deducted or claimed from the PSC, and in contrast, there'll be very few expenses that an employee can normally claim if they were working in a similar way. So after those payments have been taken, that will leave a profit in the limited company. So if the sales income has been several tens of thousands of pounds, and Dave, the employee of the PSC, has decided to take a small salary, there'll be a profit left. And that profit will be subject to corporation tax. And the profit after corporation tax, which we describe as reserves, can be drawn when needed, normally as a dividend, and it'll be subject to dividend tax in the hands of the contractor. So Dave is the director of his PSC. He's also a shareholder, which will allow him to take dividends. And when he takes dividends, apart from the first few £1,000s, he'll be paying tax on those dividends as well. So that's broadly how the tax applies to each case. So what's the comparison? The employee, so if you're getting paid, if Dave was being paid directly by the agency as an employee or via an umbrella company, the employee is taxed in full on all of their pay each week or each month. The cost to the supply chain, as we heard earlier, also includes employers' national insurance on top of the gross salary, pension auto-enrolment payments, apprenticeship levy potentially if the payroll is large enough, and of course, the other cost of the supply chain is the costs of running payroll. So whether it's an umbrella who is being paid for running payroll, or if it's the agency having a payroll department to pay the employee, that cost is also a cost to the supply chain. The limited company contractor, by contrast, will pay little or no national insurance. They can choose when to take dividends, which may allow a more tax-efficient extraction of funds. So, for example, if someone's had a very high salary through PAYE during a tax year, but towards the end of that tax year finds themselves working through a company outside IR35 again, they will probably choose to take a small or no salary, and they might want to save their dividends until the following tax year when they've got more tax-free allowance to use. So there can be the ability to do perfectly reasonable tax planning structuring, which will allow you to reduce your tax take slightly further. And the limited company contractor, as I mentioned earlier, can also claim a few more expenses normally in the course of doing their work than a regular employee would. And of course, that's because a limited company contractor who's working outside IR35 is running a business, and business taxation is not quite the same as employee taxation. So in general, overall, you end up paying less tax as a proportion of your cost of the supply chain as a limited company contractor compared to being an employee. So if the same £50,000, say, is being allocated to spending money for a piece of work to be done, if that work is done by an employee, a bigger percentage of that £50,000 will end up being deducted in tax than it would be if the same money was going through a limited company outside IR35. So what is this IR35 thing? We've just talked about the comparison between a limited company contractor and an employee. And IR35 was designed by the government in response to this. It's called IR35 because it stands for Inland Revenue, with the old name for HM Revenue and Customs. It was their press release number 35, so IR35. And it says, if someone's acting like an employee, then they must pay tax on their invoices like an employee. So if someone's working through a PSC, but really is working in exactly the same way as an employee would, then IR35 aims to collect more tax from that income. So to make up this difference between the employed tax percentage and the tax that might be suffered if you're working through a PSC and only taking a small salary. The way it works is that the invoice value that goes into the PSC, that goes into Dave Limited, 5% is deducted from that, and the remaining 95% is treated as employers' national insurance and gross pay. So it might be, say, 85% gross pay and 10% employers' national insurance after taking off that original 5%. And that gross pay of 85% is taxed, and that tax, being PAYE and employees' national insurance, is added to the employer's national insurance and paid over by Dave Limited to HMRC. So that sounds simple. We say, is somebody an employee? And if so, we take some more tax from them. But how do we decide if someone is an employee? So let's look at our supply chain again. Effectively, as we said, we've got Dave, who is the person who is managing to fulfill a piece of work for the benefit of an end client. In simple terms, effectively, Dave is, you could consider Dave's working almost directly for the end user, or certainly the benefit of his work is ending up with the end user. And the end user is making a payment, a significant proportion of which hopefully is ending up with Dave. So what we say for IR35 purposes, for employment status purposes, is if we ignore the exact legal form of any contracts that might be in place in the supply chain at the moment, we say, is the work that Dave is doing, what Dave is delivering, is that being done in the manner of an employee and employer relationship? So does Dave look like an employee of the end user? And if he does, we say he's caught, or he's inside IR35, or that piece of work is caught or inside IR35. In technical terms, what we're talking about is we imagine a contract between the end user, so the client at the top of the tree, and the contractor, Dave. So we imagine that contract. We'll base that imagined contract on both the actual contracts in place, but also, very importantly, most importantly, the actual working practices in place. And then once we've imagined that contract, we say, is that imagined contract a contract of service, and therefore one of employment, or is it a contract for services, a business-to-business relationship? So again, that sounds reasonably simple, but of course it's not. So what we have to do is look at that imagined contract and try and pull some features out of it. I'll describe each of these in slightly more detail, but they are, in headline terms, firstly, what's known as the big three, although they're not the only important factors. They are mutuality of obligation, control, and substitution. And often discussion of cases, employment status cases in court, tend to focus on one or more of those key factors. But they're not the only things that are considered. There are other factors such as the financial risk. Is Dave Limited, the company, taking any financial risk? Part and parcel, does Dave look like he works at the end client, or does he look like he's a visiting contractor just carrying out a piece of work? And overall, whoever's making an employment status decision will ask the question, is the worker, is Dave and Dave Limited, is that operation in business on its own account? Is Dave running a business, or is Dave an employee who's pretending to run a business? So first of all, mutuality of obligation. This is a feeling of continued relationship and an ongoing commitment between the imagined employer and the imagined employee. So we ask ourselves, is the situation that the worker, the employee, Dave, in this situation, will Dave continue to turn up for work, and the employer, the end user, will continue to offer work? Is that the case or not? It can be very hard to describe mutuality of obligation. Whole books are written on it, and it's argued about endlessly. HMRC and the rest of the group of people thinking about employment status tend to have a lot of arguments around mutuality of obligation. And there are court cases going on at the moment, which we hope might give us all some more clarity. But let's suffice to say, it's a very, very complicated area. Contracts, of course, always have obligations in them, but business-to-business contracts have those, and they don't create employment relationships. So it's very important to try and be very careful about what we mean when we talk about mutuality of obligation. As an example, which I find can be helpful to kind of illustrate it, if you imagine an aeroplane factory will only operate if all the monitoring systems are in place, so that every component that's gone into an aeroplane can be tracked and traced, which is important for safety reasons later. If you imagine an aeroplane factory which has people in it who are carrying out work, and a mixture, that is, of employees and self-employed contractors, so people who are outside IR35. If the systems in that factory broke down during the day so that aeroplane manufacture could not continue for safety reasons, then it would be very common to see the contractors in that factory being sent home, and they wouldn't get paid for the afternoon because there's now no work to do, so they've been sent home, and the end user's not obliged to pay them. Whereas the employees in the factory, it would most likely either be sent home or be given other things to do in the factory. Either way, they'd still get paid for the afternoon, and that's because of the obligations that exist between them and their employer. Next, we'll look at control. So this is control, but it's a type of control. It's controlling the manner in which work is completed. All contracts, of course, have deliverables. So if I sign a contract with someone else, it will probably say that I or they are going to do something, and in response to that, I or they are going to do something else. There are always deliverables in contracts, but the question is, are they milestones or detailed hourly instructions? Are we saying what someone does during each part of their day? Or are we just saying that after a period of time, we want something to be completed? My example here is if I was engaging somebody to build a wall in my garden, a builder, most people would look at that situation and they probably wouldn't imagine that I was employing the builder during a period of time. They would imagine I was contracting with the builder to have something done. So I would give the builder very, very detailed specifications about the wall. I would say where I wanted it, what job it had to do, was it decorative, was it structural? I would probably say exactly where it should be placed. I may also put some conditions on when I wanted it completed by, and I might also put some conditions in saying that I don't want work done on a certain period of time. Perhaps I'm going to use the garden for something important. So I'll put all sorts of conditions around what I want this wall to look like, when I want it delivered, potentially when I want some of the work not done. But I'm not going to tell the builder exactly how to place each brick or how to mix cement or whatever. That's his job. So my specifications might be very detailed, but I'm not going to control how he delivers that to me, apart from any operational constraints I have, such as when I want to use the garden. So in that case, although I've given very detailed specifications, I'm not controlling the builder to the extent that would create an employment relationship between us. Next, we have substitution, the last of the kind of big three. And what it says here is an unfettered right. So the principle of substitution here is that the PSC, Dave Limited, in our supply chain, must have the right to send someone else other than Dave to do the work. The PSC, Dave Limited, will pay this person. So if Steve comes and does the work, the PSC, Dave Limited, will pay either Steve, or perhaps Steve has his own limited company, Steve Limited. But the rest of the contractual chain will be the same. So the end user would still pay the agency, and the agency would still pay Dave Limited. If it's not that kind of substitution, then it's not really the kind of substitution that we're looking at in employment status. Now, it says above an unfettered right. It's okay to have conditions around who can substitute. For example, or who can serve as a substitute. So for example, security clearance. If we have a secure location, it's perfectly reasonable to insist that a replacement also has security clearance. But it's not okay to leave the decision over accepting a substitute to the end user. So you can't say, I'll send a substitute and you can decide if you like them or not. That's not okay, because effectively what's happening there is a new engagement. It's not substitution. Now, a reasonable example of a criteria that could be used would be gas safe. It's a recognised accreditation in a certain industry. So if you'd engage somebody to provide work who had a gas safe certificate, it would be reasonable to insist that any substitute also had a similar certificate. So it's an understandable objective requirement. It would not be okay, as mentioned before, just to say that I'll send someone and you can decide, end user, if you like them or not. That's not the right kind of substitution. Mentioned earlier, in business on your own account. So does Dave Limited look like a business? Does the PSC carry insurance? Another question that used to be more relevant than it is now is, does it have business premises? So of course, nowadays, many people running their own business don't need business premises. Perhaps they're entirely technology driven or whatever else. But then the modern equivalent of business premises is an online presence, perhaps. So do they have a website that shows what work the PSC does? Do they have testimonials saying how good Dave Limited's project management is, or something similar? Does Dave Limited have an obligation to put work right at his own costs? If work is delivered but it's not delivered to a certain standard, does Dave Limited have to put the work right at their own cost? Or will the end user just continue to pay Dave until the job is done? Because that sounds more like an employee relationship. Do contractors operating at the end client's premises look and work just like employees? Can anyone tell the difference? That's a big question, and it's an important indicator as to whether or not the worker has effectively become like an employee. Examples of that would be whether work is being monitored in exactly the same way as an employee. So are you in a performance management system just like an employee? Are you on the holiday planner? Of course, you're not an employee. You shouldn't be subject to the same rules on holidays. So to recap, overall, if we're thinking about the whole situation, if we're looking for to say, right, what is the status here? Let's say we're aiming for an outside status or a not core status, a non-employee situation for IR35. We want a lack of mutuality of obligation. So we don't want the end user to be obliged to continue to provide work. We want very little control in how work is carried out. So we don't want the end user directing what happens every single hour of the day for the worker. We want an unfettered right to substitute. So ideally we want Dave to be able to be substituted, and we don't want the end user to have any significant say in who that substitute can be. We want to see evidence that the contractor's in business on their own account, but we don't need all of the above. So, for example, in some recent cases, it's been accepted that a worker who's trying to say they're outside probably has some mutuality of obligation. There is some control over how they do their work, and they don't have the ability to substitute. But sometimes whoever's making the status decision will look at the whole situation and say, despite all of that, I still think the contractor's in business on their own account, so I don't think they're an employee. So important point there to just review. It's the whole situation that we look at. So although these individual factors are important, we do take an overall view in the end. So based on all that, what are a few common myths? These are based on things I hear from contractors and recruitment partners and end users from time to time. Is it true that all long engagements are caught? So is it the case that if you've been with one end user for a significant period of time, you're bound to be inside IR35? The answer is no, in terms of there is no length of engagement that means that something is caught. However, it is true to say that the longer an engagement is, the more likely it is that a worker is going to slip into habits and working practices that make them look more like an employee. So, for example, if they're very careful at first to make sure that they're not appraised like an employee, they're not on the holiday planner, etc., those things become a bigger risk over time. People get sloppy, people don't do the right paperwork, and people start acting a different way. So no, long engagements are not caught by virtue of their length. However, the length of an engagement can increase the risk of someone's working practices changing. Contractors often say to me, I've got more than one end client, so I'm absolutely fine, aren't I? I must be outside. Again, there's a little bit of truth in this myth. It is likely that the kind of contractor who has lots of different clients or moves around very regularly is more likely to be outside IR35. But that, again, is because the way they structure their work, the way they engage with an end client, is much more likely to be on a self-employed basis because of the changes that continually happen. Whereas the kind of contractor that stays in one place and only ever has one client is more likely to be working like an employee. So, as I mentioned, having more than one client and moving around regularly is probably going to indicate that you're more likely to be outside, but that's by virtue of how you engage with the supply chain. Just engineering a situation, for example, where you have more than one client to make yourself look outside isn't going to make you outside IR35. If your original engagement with one client was inside, it's still going to be inside, despite the fact you've now engaged with another client. The next point is, of course, critically important, although we have already covered it briefly. If my contract says I'm not an employee, am I okay? And of course, as we mentioned before, we imagine a new contract when we're doing an employment status assessment, and that contract, it will be informed by what's in the written contracts, but it won't be overridden by reality. So a contract that just has a line in it saying I'm not an employee, that will be ignored in an employment status decision if it's not supported by the working practices. My agency can substitute me, so is that okay? Well, as we've heard earlier, no, that's not the right kind of substitution that we're looking for. It's Dave Limited that needs to be able to substitute. Obviously, the agency will have to be on board with that, as will the end user, but the agency can't find a substitute. And it's my agency's problem if my status is incorrect. I hear this regularly from contractors. If the end user, if the supply chain allowed it, if the agency allowed it, it's their problem, isn't it? And of course, the case is now, in the private sector at least, today, it's entirely the contractor's problem if they've treated their own status wrongly. However, in the public sector from April 2017 and in the private sector soon in April 21, it may well be the agency or the end user's problem. Just to consolidate that, what does an employee look like? So an inside IR35 person. They can be directed to do different things at will. So you might turn up for work one day and in the afternoon be doing something different to what you were doing in the morning because your employer needs you to. You're not normally as an employee just there for one discrete project. You're more likely as an employee to get benefits like gym, parking, and Christmas parties and so on. You don't have to tender for each piece of work you do. You're an employee, so you just work until there is no work to be done, and then you look what else can be done. And you have to book time off using a staff system. You'll normally be subject to close performance management, so more than just a check on whether you delivered what you should deliver. And you're going to be closely controlled and managed. So they're all the features that make you look like an employee. and therefore inside IR35. So what is the problem with IR35? Why have the revenue been trying to change it? Well, on the original rules, the old IR35 rules that we talked about, the contractor decides, Dave decides if Dave and Dave Limited are inside or outside IR35. If the contractor decides they're inside, they pay a bit more tax. Contractors often tell me that they don't see HMRC doing much enforcement, and that's often levelled at them. It seems that when there is coverage of enforcement, HMRC often lose IR35 status cases. Now, of course, we have to be fair in a way to the revenue here. Cases that go all the way to court get reported on. Many cases don't go that far, and many of those will be because the contractors decided to cave in and pay. And that's never going to appear on the news anywhere. So I've got a bit of sympathy for HMRC, who tell us in private that they do a lot more work behind the scenes than we can see. But obviously what reaches the news is often only the headline cases. And there's no penalty on the end user. So the rest of the supply chain, the agency and the end user, haven't got a problem if the contractor gets it wrong. So if a contractor calls themselves outside, and later on HMRC are able to prove they should have been inside, it's the contractor that pays the extra tax. The rest of the supply chain doesn't have to worry about that. So these are the original IR35 rules, the old rules that have been in place since around the year 2000. Now, of course, arguably the end user benefits if the contractor is enabling themselves to pay a bit less tax, because there is an amount of money, obviously, that the supply chain is allocating for this piece of work. If the contractor can keep more of it, then arguably over time, the rate for that work might be a bit lower. For an agency, as mentioned before, the IR35 status on the old rules is irrelevant. So everyone, except HMRC, is happy if the contractor either takes the risk or just isn't very careful about their compliance. The only people that are losing is the taxman, and therefore obviously everybody, because taxes pay for things, but it's HMRC who are losing out on a case-by-case basis. This is currently still the case in the private sector, and that's the core problem with IR35, the old rules. So on that, they changed the rules, firstly in the public sector. So the new rules work in the following way. The responsibility for deciding moves to the end user, so moves up the chain to the top of the tree rather than the contractor. And that's in the private sector, that's unless the end user is a small business. We'll go over the definition of that in further seminars. The financial risk moves from the contractor to the fee payer. So what that means is if a contractor doesn't pay the additional taxes and the revenue later proves that they should have done, at the moment in the private sector, it's the contractor that has to pay. In the future, the first place the revenue will go is whoever paid the PSC. So that would often be the agency. If there's no agency, it would be the end user. The fee payer, that person who's paying the PSC, becomes liable for any underpayment of tax and national insurance. And therefore, agencies and end clients are taking on a new financial risk, as the liability can move back up the chain to the end client. Now, if the worker is being paid without a PSC in place or without any other intermediary in place, and full PAYE is being paid on that money, the idea of this legislation is that those workers, the revenue aren't interested in them because full tax is already being taken. I should mention that at the moment, I'm speaking at the moment in November 2020, the revenue are dealing with an issue around the drafting of the legislation that makes that situation less clear. But this is the intention of the legislation. And these new rules will apply in the private sector to work done from the 6th of April 2021. When the rules came into the public sector, so end users such as the NHS, they came in April 2017. At the time, the rules said it was payments made from the 6th of April onwards, whereas in the private sector now it's for work done from the 6th of April 2021 onwards. The rules were that the end user decides, because these rules aren't exactly the same as what's coming into the private sector. The end user decides, and whoever pays the contractor company is liable if the status is wrong. Obviously, in reality, the status is only really going to be wrong in one direction, which is it was assumed that no employment tax was due, and it was due. It's not going to be the other way around where tax was deducted and it shouldn't have been deducted. There's no 5% deduction, as we mentioned earlier. If the contractor treats themselves as inside IR35, they're allowed to take 5% off the invoice value. There's no 5% here because it's a more simple piece of legislation. So for contractors in the public sector, if the end user decides the assignment's caught and the contractor continues using their PSC, they probably would, or they may well not do, but if they did, then the assignment rate is taxed just like PAYE or an umbrella payment. So the amount paid to them is taxed as if it was a payroll amount. The contractor is therefore being taxed as an employee, but getting no employment rights. And the end user is deciding, but is effectively not liable. So in the original public sector rules that came in, it was very, very hard for liability to move up the chain to the end user. In the private sector rules, it's much easier. The off-payroll rules, the IR35 and off-payroll is used almost interchangeably. If we think of the old off-payroll rules, they were in something called Chapter 8. The new off-payroll rules are in Chapter 10. So you could say old IR35 is Chapter 8, new IR35 is Chapter 10. So they are new rules, not identical, as I mentioned, to Chapter 8. There isn't a great volume of case law or precedent so that people can use to see how they should be complying, because they're new rules. But one key difference around it is that obviously if a contractor using their own company on the old rules decides that they are inside, then they deal with the money that hits the PSC. They take all the taxes out of that. The new rules, Chapter 10, say that no deduction should be made from the rate for employers' national insurance. So employers' national insurance is liable on top of the agreed rate of pay. Now, that's important because what it means is that a contractor who's on one rate and is moved onto an employed model needs to have a new contract in place and needs to negotiate and agree with its supply chain a new rate. Otherwise, that contractor would have it would be reasonable for that contractor to suggest that amounts have been taken out of their rate unreasonably. So it's very important that that's agreed when an engagement method changes. So rates didn't, though, go up in all cases. You can see here in the column on the left, we have a worker working outside IR35 through their own limited company. The rate arrives at the limited company, and effectively deductions are made for corporation tax and dividend tax, potentially a small amount of income tax as well, and the remainder is take-home pay. If you were to take that same rate and operate payroll taxes on it, then the tax take would be bigger. And here we can see in column 2, the take-home pay has gone down. So the intention of off-payroll, as I mentioned on the previous slide, is that the employer's national insurance should be found by the supply chain and added on top, so that the worker isn't reducing their kind of gross rate of pay. But as you can see in column 4, that didn't always happen. So quite often a supply chain might say, well, the same amount of money is available as there was there before to pay the PSC. So all the employment taxes need to come out of that amount. And we saw this in particular at lower rates of pay in the public sector when the rules came in 2017. And as you can see there on column 4, the take-home pay is now massively reduced. So that's an overview of what happened in the public sector in terms of how the rules work. So what's happening then exactly in the 2021 rules that are coming into the private sector, because they are being amended slightly. The rules say that for each new assignment and each extension, and if anything changes about the assignment, then the end user, if they're not small in terms of the Companies Act, must issue a status determination statement confirming the status of each assignment and pass that to the next party in the chain and to the contractor, so to Dave or Dave Limited. And they're liable for the taxes unless they do. So if an end user doesn't issue this status determination statement and pass it on, then if later HMRC say you've paid somebody without deducting taxes and now taxes are due, the end user is liable. So if they don't issue the SGS, they never pass liability down to anyone else. So a good assessment is key, and this is critical here. The risk of liability being moved around the chain is made much larger if your assessments aren't good. So if your assessments are very good, you're unlikely to pay a contractor who's inside IR35. You're unlikely to allow them to be paid without taxes being paid. And therefore, it's unlikely that HMRC are going to have an amount of unpaid tax to chase after, whether from you or the agency in the chain or anyone else. So a good assessment is key. If you're only finding people outside who are outside, so they're the only people you're allowing to get paid without tax being deducted, then your risk as an end user or an agency is lower, much, much lower. So can the supply chain protect itself apart from the overriding issue of having the best assignments possible? The end user, as I mentioned, they pass the liability on down the chain if they do the assessment using reasonable care and pass it on via a status determination statement. The agency is then liable if they've received that SDS. They can pass the liability on if there's another link in the chain, and it can show, the agency can show it passed the decision on. So with all this, it's very important we keep the evidence that we've received and passed on the decisions. So if there's then a separate fee payer, not the agency, if tax was not paid and HMRC think it should have been, then they'll go to that fee payer first. So here's an example of that. Here we've got quite a long supply chain, but it would be perfectly possible, generally speaking, agency 1, 2, 3, and the fee payer here might all be just one agency. But in this situation, something slightly different has happened. So we've got an end client on the left-hand side. They've engaged an agency, agency 1, who have engaged agency 2, who've engaged agency 3, and then a separate fee payer is in place. So agency 3 are paying a fee payer, and the fee payer is paying the PSC. Now, in this example, the PSC has been paid gross. So although the end client issued a status determination, which went to agency 1, the gold arrow at the top, and that went to agency 2, which went to agency 3, that decision was not shared by agency 3 to the fee payer. The fee payer, having not received an SDS, paid the PSC gross because it had no reason not to. So if the revenue then came to look at this situation, they would say, right, who paid the PSC? That was the fee payer, but they didn't get an SDS. Of course, there are questions legally about how you prove you didn't get something, but this is the situation we're in. So they will go to agency 3 and say, you didn't pass on an SDS, we want the money that should have been deducted from the payment to the PSC. If agency 3 couldn't pay, then the rules say that the top agency in the chain is the next place HMRC would go, agency 1. Agency 2 wouldn't be asked to do anything. Here, of course, agency 2 has complied with the rules. It's received and passed on the SDS. But so the next point after agency 3 here is agency 1. And if the revenue can't collect from agency 1, then they go to the end client. So this is how liability can transfer down and back up the chain. Here, let's not forget though, the end client and agency 1 did do what they're supposed to do in the legislation. The end client made a decision and passed it on. Agency 1 received the decision and passed it on, but they could still end up liable. So, as I mentioned before, good assessments are key here. What are your options as an end user? You could employ some employment status experts to do these assessments for you. You could use CEST, HMRC's assessment tool. You could get an opinion from a firm of experts on your contractual situation. You could get access to other tools or other providers, maybe better online questions, maybe expert intervention where cases become difficult. You've also, obviously, with any risk, you can consider getting insurance, but you need to very carefully consider insurance to make sure it is insuring you against what you think it is insuring you against. But critically, the solution to getting assessments done well is to involve the whole supply chain. Everyone's got to be on board with what you're doing. And yeah, if that's not the case, then the assessment process won't be smooth and won't work well enough, won't provide the audit evidence you need to comply with the rules. So getting these assessments done, for it to be a useful solution, whatever you want to pick, you need a known and acceptable cost, whether that's in-house resource or if you're outsourcing the decisions, how much are they going to cost? Is that reasonable for you per contractor? You need to be able to operate those quickly at high volumes, especially there'll be humps on this. First obvious one is in March 2021, when all the contracts in place that run into April are going to need to be assessed. So you're going to have peaks and troughs in demand for these assessments. The assessments need to fit into, or to be done, need to be fitted into redesigned procedures. So, for example, if a contract is renewed, your systems need to trigger the fact that that means the status assessment needs to be revisited. Your solution needs to be documented and not overridden, so that you can demonstrate to HMRC that you're taking reasonable care. And again, as mentioned before, the whole supply chain has got to be on board with the solutions that you're using. So in order that the process works, the end user must be involved. So although the supply chain can help with compliance here, the end user must be involved and responsible for the decision. Blanketing of any type should be avoided. So that will be where you perhaps assess one contractor and then assume that that applies to every other contractor you've got in the supply chain. That's very dangerous and wrong in law. The supply chain must keep evidence it passed the decision on. So you've got to have an audit trail for what's going on so you can show the revenue what didn't happen. But it's very difficult to know exactly what will be okay from the revenue. The law requires that the end user makes the decision using reasonable care and that the supply chain operates as carefully and properly as possible. But at the moment, we don't have case law on what good compliance and non-compliance looks like. There is some guidance from HMRC in their employment status manual and in other places, but yeah, it's all you can do is try and take advice from the people who are advising you and keep all the evidence you can. So obviously the objective here is to protect us all from liability. Can you remove liability? As I mentioned on that supply chain diagram earlier, if HMRC can't collect from the fee payer, then they'll go to the agency nearest the end user or the end client. And if they can't collect there, then they'll go to the end client themselves. They have said around their guidance that they'd only look to do this if they could see systematic abuse. But again, there's no kind of exact definition of what that is. The best thing you can do is protect yourself as well as possible by ensuring that your systems are working correctly and working all the time. So there's no way to completely remove liability because these powers do exist for collection up the chain. But again, good quality assessments are critical to minimizing that liability. So if, again, you're only engaging with people outside IR35 who should be, then the revenue aren't going to have much missed tax to come to you to collect because, yeah, though that tax should not have been deducted correctly if your assessments are accurate. What did we see in the public sector? Well, in April 2017, supply chains weren't generally ready and they didn't understand the new law. The law came in very, very fast. Assessments were either not done at all or done badly with a lot of blanketing in place. Lots and lots of non-compliant umbrella companies were set up. And that's because, as we saw earlier, the take-home pay for the workers reduced massively. And so non-compliant umbrella companies who were able to offer much higher rates of take-home pay were a very attractive option for some workers, especially if the workers didn't really understand what the risks were. End users often left compliance to their agencies. And of course, as we can see with the new rules that are coming, because of liability transfer, the end user is going to want to know everyone who's in their chain. Rates, especially at low pay rates, rates weren't increased. And as a result, agencies had their margins squeezed to try and increase the rates of take-home pay for their workers. Agencies just weren't familiar enough with the impact on take-home pay, and neither were end clients. End clients maybe perhaps a little bit put their fingers in their ears and didn't want to know about it. Some end users, though, originally they might have started off by blanket banning, but then and perhaps used CEST, which was one of the first things available at the time. But after that, they often worked with agencies and other providers to work out when they could operate outside IR35 with their contractors, and then were able to prosper from the disruption. So if you were an end user or an agency who did know how to find a contractor properly outside IR35, then suddenly you were very attractive to other supply chains because you could show them where possible how to properly deal with the rules, but still maximise the take-home pay of the contractors, which of course kept them happy. And we can expect end users again this time round, agencies and end users, those that are prepared will be able to win work from people who aren't. We do expect the next thing that we'll see in the private sector will be that more and more private sector end users will initially panic and ban the use of PSCs. We saw this in April 2020, before the rollout of off-payroll was delayed in the private sector. Lots of big financial institutions and others banned PSCs outright, or they tried to make everybody either permanent, as in a permanent employee, or something similar. So some end users will do that again, I'm sure. But of course, the impact of that is that then you'll have less talent available. And also some people will demand more money in order to preserve their take-home pay. So there is a huge commercial risk to not trying to work with contractors outside where it is appropriate to do so. We also expect in the next few months to see more and more non-compliant offerings emerging. We are seeing lots and lots of people advertising at the moment with high take-home. It's the normal thing that is advertised to most workers. It just says, yeah, we can get you more take-home than anyone else. The fact of the matter is that there aren't compliant ways to do that using payroll. If someone is payrolling you, but you're not paying as much tax as someone else is payrolling you, that's got to give you a lot of causes to worry. And of course, yeah, as mentioned, this is why the non-compliance thing is such a big issue. The amount of money on the right here that's necessary for a supply chain to put in, if you're moving a contractor from the left-hand side, where they're working outside IR35 through their own PSC, if you're moving them over to the right-hand side, the supply chain needs to find quite a bit more money to mean that the contractor gets the same take-home pay as they would have done originally. And the reality is, of course, in most supply chains, it depends how important those contractors are. They're probably going to end up on a pay rate that's somewhere in between column 2 and column 3, and that's going to be down to normal commercial factors. How unusual is their skill set? How valuable are they to the supply chain? The fact is, yeah, the contractor is obviously going to want to be as near to column 3 as possible, and the supply chain is going to initially at least want to be as near to column 2 as possible. What can we expect next? We'll see a rolling back, I think, after the initial panicking towards the current status quo, but I don't think it's ever going to be exactly the same as it was before, because there's no doubt no one in our sector would claim that everybody who was working outside IR35 should have been. There were a lot of people who were effectively filling temporary employee roles, but were encouraged or allowed to work through a PSC and pay less tax. Those people shouldn't have been working outside IR35. And I don't think that population will get back to where they were before. But a lot of other contractors who are working outside might find that the initial panicking softens after a period. We expect to see more consultancy arrangements. That is where a recruitment partner instead of just supplying workers, supplies a whole service. So their contract with the end user will be to deliver an entire website or deliver an entire project. That will increase, we expect, because in that situation, if it is a whole service that's being provided, the end user actually becomes the recruitment partner, which protects the end user, the original end user, from liability transfer. There'll be more about that in the next seminar. And also around that, I expect to see more and more innovation. A lot of people, when they're faced with this legislation, start off by saying, well, that's all right, I'm just going to put all my contracts on statements of work, as if that will magically mean that everybody is insulated from any inquiry from HMRC. That's not the case. It doesn't work like that. However, where a piece of work can properly be described on a statement of work, it may well be outside IR35. So the point here is, statements of work arrangements and consultancy arrangements may well give a good solution for a lot of people, but they can't just be used as like a rubber stamp to make a situation that is inside IR35 magically outside. So finally, a quick checklist of what to do if you're an agency or an end user. First off, you need to work out if you've got a problem at all. What's the status of the contractors you have now? Do you know that? One of the problems with these rules is that until the rules come in, the agency and the end user may well not care very much if what the status of their contractors is, because there is no financial risk. So you need to find out first if you've got a problem with your contractors. So get a sample of those assessed. And when you get the results of those assessments, can you make the situation better for borderline cases? So if you've got people who are, it's not clear whether they're inside or outside, what factors are affecting that? Can you make the situation better if you want people to be outside? Or you might find as well with those that are probably inside, if you want to fundamentally make them inside and then make them proper employees, you'll probably get better engagement from those people as well, if they're prepared to work that way. And overall, of course, get professional help. This can't be something that you just have a little go at, because the long-term implications of it are enormous. Then you need to do some internal planning. Based on the sample assessments that you've been doing, do you need to amend your contracts? But of course, you can't just amend contracts, you need to amend working practices if the working practices are unhelpful. Build the assessment requirements into your onboarding and extension procedures. So make sure that your compliance teams and whatever else are putting in the things they need to ensure that you comply with the legislation. Do consider outsourced service provision. There are lots of people in the marketplace who can help with this, and they do it all the time. They will probably do it better than you can until you've been properly trained. So get their help. Communicate with the whole supply chain, of course, and make sure you know who is in your supply chain. The point of these rules overall is to make the end user and the agency far more responsible for what happens lower down in the supply chain. So it's very important for you that you make sure you know who that is. And of course, one of the reasons we're talking today is the FCSA on this subject is because FCSA accredited membership is a very good marker to look for people in your supply chain. And then finally, the next things you need to do right now are talk to your contractors, find out whether they understand the rules. Have they previously had their status assessed? If they have, it would be very useful for you to know what those status assessments look like, or whether they have a quality that you can accept, and whether they came out inside or outside. Do you know if your contractors will accept payroll rules? Have they spoken to you about it? Some supply chains find they have a lot of noise about this sort of thing, some don't. You need to work out as a calculation exercise, what rate would the contractors be prepared to accept based on what they need to live on? What changes will be needed to your rates to put them back where they'd like to be. But of course, that's not saying that you need to make sure take-home pay never changes for any of your contractors. It's just that in order for you to start doing the calculations, start working out what the impact is going to be on the cost of your workforces, you need to know what the contractors, how much worse off the contractor might be feeling, what they might see as a reasonable compromise on rates. So once you've had a think about what will happen with rates, finally, the biggest question of all, do you understand what's going to happen if your competitors are able to engage outside IR35 and you're not? The key point here is banning, blanket banning PSCs seems it's an attractive short-term plan because you don't then need to comply with any of these new rules. If you've got a policy of never using a PSC, then you don't need to comply with these rules at all. However, in the long run, that's going to mean that the people who are prepared to work for you and the rates they're prepared to accept are going to be significantly different from what you're working with now. So that's the issue, and that's what you need to do to plan in detail to work well with these rules. It's perfectly possible to engage people outside IR35 once these rules come in, but you've got to do it properly, and the risks of doing it badly are, of course, enormous. So that's a broad overview of IR35 and what's changing. I'll hand you back over now to Phil. Thanks very much for listening.
Thank you, Chris. for a really insightful presentation on what is the first of our 3 webinars regarding IR35 reforms. If you would like more information on IR35, please do access our website, fcsa.org.uk, where you will find our IR35 hub, and on that, you will also find a useful guide that you can download specifically designed for end users and recruitment agencies. For other ways to stay connected and to access information from FCSA, here are just a few examples. Thank you.